Well, the corporate watchdog fears a looming disaster involving thousands of retirees and small investors. High interest payments are luring them into a form of investment that may provide a good income stream, but with big risks. It's known as a hybrid security. Well, already thousands of investors have suffered big losses as companies suspend interest payments on hybrids. And the number could rise substantially if the global financial crisis gets worse. Stephen Long reports.
Just as hybrids are the new fashion in transport, hybrids of a different kind are the new big thing for investors.
This is a growing market. We're seeing household names raising funds through these sorts of offers. We're seeing fundraisings in the hundreds of millions of dollars in Australia through these sorts of securities.
Woolworths alone raised $700 million by issuing so-called hybrid securities, and the demand was so overwhelming they could have sold the issue 3 times over. Big banks and other blue-chip firms have collectively raised billions as people flock to an investment that's neither a bond nor a share, but something in between.
The characteristics of hybrids is a mixture of shares and bonds. They tend to have share-type characteristics of risk and volatility, but they have bond-like returns.
And in some instances, they may be below conventional investment grade, what some people might call junk bonds.
But as far as thousands of retirees and small investors are concerned, hybrids pay a lot more than money in the bank, even in a high-interest term deposit, and they're backed by trusted brands. So what could possibly go wrong?
There are several risks with these sorts of investments. The first is that they are subordinated, and by that I mean if the company that's issuing them gets into trouble and goes under, you'll be at the back of the queue when it comes to getting your money back. Another risk is that the issuers can actually stop paying you interest for a while, in some cases several years. And when that happens, you can run into the third risk, which is that the face value, the value that you've paid for these investments, can go downwards very rapidly and very significantly.
Just ask Graham Critchley, a self-funded retiree, though less well-funded than he used to be.
The lost income for the half year to December would be about 100,000.
He considers himself a sophisticated investor, and he's been a fan of hybrids.
All things being equal, they're sound fixed interest investments.
But he's done serious dough investing in hybrids issued by a company called Paperlinks.
On paper, about 300,000, I guess. I bought them after they'd fallen, so I'm a lucky one. But still, my exposure is substantial. It's more than the value of an average house.
Paperlinks raised $285 million in 2007, issuing hybrid securities with a face value of $100 each.
And those units are now trading at $18, $19. So somewhere, people have lost, along the way, 80% of their investment. Now, it's 80% of investing in a trusted brand, Paperlinks, been around for years.
Investors were lured by the prospect of 6 monthly interest payments at a very attractive rate. The prospectus did warn that the payments could be suspended at the issuer's discretion, and it's no secret Paperlinks has faced troubled times. But Graham Critchley didn't expect the payments to stop when Paperlinks had positive cash flows and was paying its debts.
In August, we got the annual accounts released, and they were very positive. I mean, to say gearing was 19%. They had $55 million of positive cash flow for the year.
Paperlinks cites the downturn in Europe, where it does 70% of its business, and a big slump in the global paper market, saying this made it prudent to suspend the interest payments on its hybrids and preserve cash. It's not alone. The agribusiness company Elders suspended interest payments on its hybrid securities 2 years ago, and on the 21st of December, it extended the ban until at least the end of next year.
That is the risk that we're talking about here. People may not end up with payments for an extended period of time, or they may end up with an investment that's worth considerably less than they originally paid. And it's vital that investors do understand this. Otherwise, please put your money elsewhere.
In theory, you can always sell your hybrids, but if they're not paying interest, it can be hard to find a buyer. So you can end up stuck with virtually worthless paper. And some of these hybrids have a maturity of up to 60 years. Nigel Stewart is an investment advisor who fears that hybrids are being aggressively marketed to the wrong people.
The people who are selling the products in the market, they tend to be selling the sizzle, they're selling what is attractive, and they're not selling what the underlying risks of the products are.
The corporate watchdog is on the lookout for shonky salesmen.
ASIC is sending a very clear message that those brokers and advisors have to be upfront and very clear about the risks involved. If we see any widespread misinformation or failure to explain the risks, then we'll certainly be acting.
The gathering financial tempest could leave thousands more people locked into dud investments that pay no income.
That report from Stephen Long.